please welcome the New York City Comptroller's Chief Diversity Officer, Wendy Garcia.
Good morning. All right, good morning. All right. Welcome. Welcome to the annual Emerging and MWBE Investment Manager Conference. We are here today to talk about how to reinvent what it means to be an investor. No matter how high your heels are or what zip code you were born into, this conference is for you. My name is Wendy Garcia, and I am the Comptroller's Chief Diversity Officer. My position didn't exist before the Comptroller Stringer created it. And it's my job to be the fiscal watchdog across New York City for women and minority-owned businesses. I focus on the city as it uses its financial power to give diverse firms a fair shot in everything from contracts to investments. And I work every day to keep systemic racism and exclusion out of the halls of government. My team makes sure that people of color and women have a seat at the table by pushing global companies to add diverse directors. We implement policies that boost diversity in the investment world by making sure that people who are managing the funds represent the communities of our pensioners. And we help New Yorkers keep the city accountable by digging through city data and grading every city agency on their contracting with MWBEs. You see, this is important because, as actress Viola Davis said, the only thing that separates women and people of color from everyone else is opportunity. At a time when Washington is attacking the values of our country, we need accountability, we need transparency at every single level to ensure that we are not going backwards. For those of you who are investors in the room, raise your hand if you're an investor. Okay, this is for you. Remember that your decisions play a role in the economic health of this great city. Because when you invest in emerging and MWBE managers, you are investing in better returns. This has been proven time and time again. So this morning, I am proud to introduce to you a man who truly understands the value of diversity. New York City Comptroller Scott Stringer has spent his career in public service fighting to ensure that every New Yorker has an equal opportunity to make sure that you can make it in this city. I've had the distinct honor of working with him for the past 10 years and being able to see up close the values that guide his decisions. When it comes to diversity, I know Scott is thinking about his own family. He was raised by his Puerto Rican stepdad and a mother who made history as the first woman, and you can give a round of applause for this, as the first woman to ever hold office and elected in Washington Heights. That is why, over the last 2 decades, Scott has been able to champion policies like the $15 minimum wage, affordable housing, strengthening the city's fiscal health, and promoting an open and transparent government. He brings the energy, the enthusiasm to shake things up by doing what is best for the funds and also keeping the interests of New Yorkers in the forefront. Just this year, he led the way for New Yorkers to become the first pension system in the nation to fully divest from private prison systems, companies which violate human rights. He is a true New Yorker, born and raised, spending his entire life in community service. A fun fact that you may not know is that he joined a community board when he was just 16 years old. Scott was elected to the New York State Assembly and later Manhattan Borough President. He was elected as Comptroller in 2013, and last year he was reelected again, thanks to all of you. So without further ado, please put your hands together and help me welcome New York City Comptroller Scott M. Stringer.
Thank you. Thank you. Thank you, Wendy Garcia. Let's give a big round of applause for the Chief Diversity Officer of New York City. I also want to recognize the first Chief Diversity Officer who we appointed when I became controller. Carl Wallace is here, and thank you. I'm very proud to be the 44th controller of New York City, but before 44 came 42, so Controller Bill Thompson is with us today. Thank you, Bill. I also want to truly thank the trustees of this amazing pension system. They work every day protecting the retirement security of their members, and they hold me to the highest standards and hold me to be accountable. Let's give a big round of applause for all the trustees of this pension system. I'm going to ask you to thank the New York Academy of Medicine for providing this space. This is pretty awesome, right? So give them a round of applause. I also want to reintroduce someone who's worked with me for many years and is now the first Deputy Controller of New York City. Elena Gilligo is here. And the Interim Chief Investment Officer, Alex Dunye, is here with us today. You're going to be hearing from him. So I want to welcome everyone to our annual Emerging and MWBE Manager Conference. And I'd like to say to all of you, thank you for being here. Many of the issues that we are going to talk about today have, I think, very important meaning. And one of the major issues we tackled early on was diversity, to take it into the mainstream and to make it a part of everything we do. Because in New York City, diversity isn't just a buzzword. It's actually a way of life. 65% of New Yorkers are women or people of color. Diversity in this town is for real. But despite our proud status as a melting pot, New York City's diversity isn't always reflected in our economy, both here and across the country. Just take a look at the New York Times article from last week that showed women make up less than 5% of CEOs of S&P 500 companies, just 5%. And just this year, Fortune magazine announced 2018 as having the fewest number of African American CEOs since 2002. So we're actually moving in the wrong direction. And while corporate boards are becoming more diverse, men still hold about 80% of all the board seats. Because for too many people, even those who went to the best schools, the elevator to the C-suites and the corporate boardrooms isn't getting everybody to the top. That elevator is still getting stuck on the way up. And that's why it's been our mission to drive wealth creation that empowers everybody. We want to give women and people of color meaningful economic opportunity within city government. And that is why Wendy Garcia, our Chief Diversity Officer, has led such an important effort. We also made a commitment to increase investments with minority and women-owned businesses and also minority and women-owned investment managers. And we have kept that commitment. Today, the pension system assets have increased their investments by over 40%. We created the Boardroom Accountability Project to diversify corporate boards through proxy access. And in 5 years, we went from 6 companies having this policy to more than 540. We also became the first major pension system in the nation to ask prospective fund managers about their employee diversity. That not only drives accountability in the process, but it helps us identify who is most likely to achieve superior risk-adjusted returns for our retirees. And through responsible management, we have achieved average annual returns of 7.4% over the last 5 years, and that is higher than our assumed rate of return. We were able to do it by ensuring access to the best investment talent available, by promoting competition, and by diversifying our portfolio to make our investments stronger. Today's conference is a reflection of that ongoing work. But we need to do even more to move the needle on diversity. We need to act. We need to innovate. We need to break the mold. And that's why this year we created an all-new position in the Bureau of Asset Management, our first ever Director of Diversity and Inclusion. And you'll hear from her, Siobhan Sutton, later today. Her work will expand MWBE engagement and guidance on the investment side. Siobhan's mission is to break out of the echo chamber of insiders and make a real difference in this space for emerging and diverse investment managers. She is the real deal, supporting and reporting to our Chief Investment Officer. Give it up for Siobhan. You're going to hear from her later. We're great to have her here. We also raised our standards for how we do business. We started by setting an internal goal at BAM to allocate at least 10% in each asset class to top-performing, emerging, and diverse managers. To do it, we are working with the trustees to create a new program to invest in early-stage firms and first-time fund managers in alternative assets. You wanted it, you're getting it, we are doing this. Now, these are investment managers who don't usually work with large institutional investors like us, but they have the ability to outperform traditional firms. So we're actively seeking them out. And in the process, we'll bring smaller and new managers to the table, foster their growth, and develop partners for long-term success. And that's what we're doing across asset classes. But we're making sure that we're boosting diversity however we can, even within the asset classes. And that's why we're putting another $500 million to our direct private equity emerging manager program, another $500 million. And this will be our second time committing to this goal in the last 5 years. And again, I want to emphasize that we're using all avenues to bring the brightest minds to our pension teams, not just investment managers, not just in private equity, but we're also bringing MWBE brokers into the fold and expanding our MWBE brokerage program in 2 ways. So first, we're creating a new opportunity for MWBE brokers by expanding into a new asset class, specifically high yield, fixed income, asset class, in addition to our other existing programs. And now I'm proud to say that we're also opening the program up to include disabled veteran-owned firms, because diversity means expanding opportunities for everybody. We also want to build on our success by growing our existing programs. It means transitioning successful small managers from our funds to funds and emerging manager programs in general. We're also transitioning them into our direct investment programs. Many of you know that the boards do not select firms alone, but they are guided by consultants. This year, we are expanding our consultant scope of services to our plans. They will now be required to track, monitor, and identify strong emerging managers, including MWBE asset managers. They're now going to be required. This is not catch as catch can anymore. We want the impact of our initiatives to go farther and to build a pipeline for diverse managers that will have a wider impact on the industry. And as I said, we are doing this not just because it's the right thing to do. We're doing it because, let's face it, it's the smart thing to do. Diversity must be front and center in conversations about wealth creation, but it's not a box to be checked. It's a living, breathing commitment to empower people who've been fighting uphill for far too long. So it is smart to diversify because it is proven that when you diversify, you not only protect our risk, but you also create better opportunities for returns. And at the end of the day, all of you are here because we need to provide the economic security to our retirees, the people who teach our children, the people who go into burning buildings when people are moving out of them, the people who protect us every day and make sure that our city is safe, the city workers who keep this place moving. That is why we're here. That is our fiduciary responsibility. And I believe that diversity is totally and completely part of our fiduciary responsibility. That is what makes the Bureau of Asset Management strong and keeps our city strong. And that is why this conference is here today, to create this, that I believe, as we're successful in New York City, this will drive a fundamental change in corporate America and in investment strategies at public pension funds across the United States. That is the mission, and that is why we are all here. So I want to thank you for coming here, and I want to thank you for participating. We've got a great show for you today, and I think you're going to walk away having a better understanding of our mission, and we're going to have a better understanding of what all of you are about. But before we go, we want to present for the third time the Comptroller's Diverse Practitioner Awards. These awards honor firms that build a diverse and inclusive investment organization. As you heard me say, we strive to partner with investment managers that not only share in this objective, but actually show it through their staff and their strength of their policies. These awards are our show of appreciation for your partnership in this work. Yes, there are Academy Awards, there are Tony Awards, there are governors with big awards and mayors with big awards, but this is the money awards, okay? And so come on, and so with that, I hope that through these awards, others will hope to someday be on this stage and to get a controller, right? So first, I want to recognize our awardee, and that is, and give them a round of applause, the AFL-CIO Housing Investment Trust, also known as the HIT. HIT has been a strong performing manager for the system since 2002, with a focus on financing projects that create jobs and affordable housing opportunities. This includes an initiative to find investments that create economic benefits in New York City, and also community-based efforts such as working with African-American pastors to identify promising developers. They do this while providing competitive returns and the diversification of our portfolio. So please welcome Chang Su, who was just promoted to CEO this week once they knew they were getting this award, Leslie White and Carol Miriam Nixon. They're on the stage, and I'm now going to give you, here it is.
Well, thank you, and it is not true. I was not appointed based on this news, but really the three of us have been living this dream for 20 years together. So diversity is our strength at HIT. In fact, the three of us have led an investment program that has resulted in 34,000 affordable housing units funded by our program. 90% of these housing units house minority households. 75% of these units house women head of households. So diversity is our strength. It is our mission. Thank you so much.
And I just wanted to briefly thank all of you for the award as well, and to let you know that we really appreciate the commitment of Comptroller Stringer. We appreciate the commitment of BAM, led by interim CIO Alex Danye. We also want to recognize the economically targeted investment team for being committed to partnering with us and being committed to making prudent economically targeted investments, especially colleagues over there, Brian Cook and Chris Pack and others. But last but not least, we wanted to thank the trustees for their support as well. It's been an incredible partnership. We're definitely committed. Diversity of the Housing Investment Trust is truly representative of the workforce, of the investors, and the communities that we serve. And we proudly embrace the values of the American labor movement. So thank you.
Wow, thank you. Thank you very much. Thank you. Yeah, come on. Thank you. Let's give them a big round of applause. All right. Our next awardee is Artemis Real Estate Partners. Give it up for Artemis. I think everyone knows Artemis and the great legacy they've already created in the asset management industry, as well as in the emerging and diverse manager area. Artemis has consistently demonstrated a diverse investment team and strong diversity policies and practices. They are also a leader in initiating important pipeline programs and bring more diverse professionals into the real estate investment industry. Please welcome Deborah Harmon and Gina Baker Chambers accepting the award for Artemis. Give them a big round of applause.
Never. Thank you.
You want to say something?
I would love to. Will you take a picture first? Okay. Thank you. It is a pleasure, come on, over here, for Gina and I to accept this award on behalf of the Artemis team. Artemis was co-founded in 2009, this month, and we were among the first women-owned real estate private equity firms. Gina was our first associate. She was there from the beginning. She was employee number 4. And today, she is the portfolio manager for New York City, and she co-heads our emerging manager program. As Comptroller Stringer has said, diversity is not a box to be checked. It's a strategy for economic success. And we speak on behalf of all diverse practitioners in this room when we say that building diverse teams is not the easiest, it's not the most expedient, and it's certainly not the simplest to manage. But that's why, when it's done well, it can lead to significant outperformance. So we thank the New York City Retirement System for your leadership, to the real estate team for your partnership, because collectively, we are widening the circle of opportunity for those that are underrepresented in the real estate industry. Thank you.
Thank you very much. Great to meet you. Here we go.
Okay.
One programming note, NBC has just gone to commercial break. When we come back for the next award, you really have to cheer and wave. Okay, so just give us 2 minutes. Okay, 5, 4, 3, ready? Okay, Elena, Susanna? Okay. Last but not least, JAI Partners, come on, applaud, right, welcome back, it's great. GIA Partners is a Hispanic-owned fixed income manager with approximately $2.4 billion of assets invested globally. They are a small organization and a tight team, but they have managed to build diversity among their senior staff and investment professionals. They have also established strong policies and processes to promote equal employment opportunities, and their anti-harassment goals are an industry leader. Please welcome GAI. Come on up. They are an important success story. I want to welcome Eduardo Cortez, Sweetie Krishnan, David Ellis, and Arnold West representing GIA. And give them one more round of applause. Come on up. How are you, sir? Good to see you. Congratulations. Good to see you. How are you? Good to see you.
On behalf of GIA, I would like to thank Comptroller Stringer, the trustees, the Bureau of Asset Management, and its fine staff for this prestigious award. We feel honored to work for and in this great city. While we adhere and believe in the principles and values represented by the award, we are hopeful that diversity in the workplace, in our daily lives, will make all institutions in the country meritorious of this same recognition. Certainly the efforts of the New York City retirement systems are getting us closer to that goal. Thank you again.
So one of the things that is very crucial about this $195 billion pension fund that's the fourth largest in the United States and 14th largest in the world is they are really big numbers that represent this retirement security of 700,000 people. And I would be lying if I told you that there have not been nights where I've woken up wondering about some investment strategy or some work that we're doing because the stakes are always so high. But one of the things we're very lucky is to have an amazing team at the Bureau of Asset Management, to have an amazing trustee in Susanna Vickers who thinks about these issues all the time, and that we have Alex Donier, our interim CIO, who is doing an amazing job. And he has been with the Comptroller's Office since 2012. He has served 16 years in investments in private equity. He is running a tight ship, and with all of our progress and of all of our thinking out of the box, at the end of the day, he believes in making sure we hit our actuarial returns. I have so much confidence in him, and he's going to now give you an important overview of the state of our pension funds so that you have a real understanding of where we're at and where we're going. So please welcome Alex Donier, and I thank you all very, very much. Enjoy the conference.
Well, good morning, everybody. Thank you for joining us from near and far on this beautiful Friday morning in New York City. And thank you to the Comptroller for your kind remarks. So I wanted to start by saying that on behalf of the Comptroller, Scott Stringer, our pension board trustees, and our dedicated staff at the Bureau of Asset Management, BAM, I would like to welcome all of you to our annual Emerging Manager and MWBE conference. I would like to thank the Comptroller for his extraordinary leadership as our city's fiscal officer and for the trust that he has placed in me to serve as interim CIO. Mr. Stringer, Mr. Comptroller Stringer is not only a leader on ethics reform, he's promoting responsible business practices at corporate boards globally. He's driving robust diversity initiatives both at the Bureau of Asset Management and throughout all the agencies and all the departments of the Comptroller's Office citywide. But he's also grown and protected the retirement assets of our 730,000 beneficiaries, driving results that have been well above our 7% rate of return. So I have a few slides for you this morning and wanted to begin by sharing some details of the current state of our pension funds. And I also want to outline our office's priorities and strategies, for many of which you, our current and prospective investment managers, have a large and important role in helping us to achieve. As you can see on this slide, as of the fiscal year that just ended, June 30th, the total plan assets across all 5 systems is approximately $196 billion. Our plans have 56 trustees. Each plan has a general consultant, and they share alternative asset consultants with other systems. Now, except for short-term investments, all funds are managed externally. Asset allocations and manager selection are recommended by BAM and the consultants and generally require the approval of the boards. You'll see on the right-hand side of the chart the returns by system for the fiscal year that just ended. You see that we generated very strong returns, exceeding both our benchmarks and the 7% assumed rate of return. We thank our managers for this achievement. Now, here in this chart, you can see the strong and steady growth in our assets under management since the global financial crisis. We went from approximately $86 billion at the trough in June of 2009 to approximately $196 billion today. And although we have enjoyed very strong returns for many years, we are aware that we are in the 9th year of a bull market in U.S. equities, as we were reminded yesterday in the markets. And as such, we are expecting to go into a period of higher volatility and lower returns. As a result, the team at BAM, together with our consultants, are taking a more defensive position with our investments, and we are looking to de-risk our portfolio where appropriate. Now, on this page, we have a snapshot of our portfolio broken out into the major categories of our asset allocation. You see at the top that we have growth assets, primarily equities, both public and private, opportunistic fixed income, non-core real estate, and hedge funds, among others, totaling approximately $129 billion. It's the largest part of our portfolio at 66%. We also have deflation hedging assets. Now, that will include treasuries, mortgages, investment-grade credit, and that's approximately $47 billion, or 24% of our portfolio. And then we have assets that provide inflation protection. That would be TIPS, core real estate, and infrastructure, among others, totaling approximately $19 billion in market value, or 10% of our combined plan assets. At BAM, we maintain a strategic approach to investing with a very long-term view. And as such, it is important for us to be diversified not only across asset classes, but across geographic regions, to take advantage of market trends and make tactical shifts when warranted. Now, in our breakout sessions, you will hear from our asset classes and consultants on specific areas of interest and manager opportunities. So I hope you will all join us for that. Now let's move on here to break down our assets and take another view of it. Here we're looking at all plan assets by the type of manager that we are investing in. And we also segment our portfolio, as you see on the right-hand side, into active and passively managed assets. We believe at BAM that it's most appropriate to measure the diversity of our portfolio within our actively managed portfolio, as our passive portfolio is comprised of index fund managers. We are very proud to have over $12.4 billion invested with MWBE firms. And that figure represents approximately 10% of our actively managed assets. But we want to continue to build on that success. Here on this slide, I do a further breakdown and provide you our breakdown by asset classes. Here we show the percent of assets within each specific asset class that is currently managed by MWBE managers. So what you see here is the utilization and the allocation of our assets to MWBEs at the end of the fiscal year. If you look at the right-hand side of the chart, you see that we have very high allocations to MWBE managers in private equity. So 17% of all private equity assets are allocated to MWBE managers. In public equities, 15% of all of our public equity assets are invested with emerging managers. And we will continue to pursue strategies to grow both public and private equity allocations to emerging managers. However, we do have some work to do in other strategies. You will see core and opportunistic fixed income, and in infrastructure, we are working to increase those numbers. I will discuss later in this presentation the strategies that we are pursuing to increase our allocations to MWBEs across all strategies. Here we discuss our MWBE brokerage program. In this program, we encourage our investment managers with who we invest in to attain certain trading goals with MWBE brokers. Now you can see our goals listed by strategy in the middle column. Through this initiative, which we began in July of 2008, we currently have 25 active brokers. BAM seeks to provide brokers opportunities to execute trades on behalf of the systems, using their latest trading technology and best execution practices. We are proud to have met or exceeded our goal in nearly all categories, and we're working on getting government bonds into the green as well. Now, as you heard from the AFL-CIO hit, economically targeted investments are a very important and critical part of New York City's investment portfolio. 2% of total pension assets are allocated to ETIs, as we call it. 1.57%, or over $2.7 billion, is currently invested or committed in ETI investments. Now, this portfolio has historically targeted affordable and workforce housing in low, moderate, and middle-income neighborhoods in New York City. But ETIs is not just limited to these types of investments. Within ETIs, we do have the ability to make investments in other projects that benefit these targeted neighborhoods, and we're working to source those investments. You'll notice in the pie chart that the AFL-CIO hit is 31% of our assets managed. Absolutely, an applause for that. They have been, as Comptroller Stringer mentioned and announced, an incredible partner with New York City, and we are excited to continue to partner with you. Now let's move to corporate governance. Corporate governance is another focus area, an important part of what we do at the Comptroller's office. Through our corporate governance group, the Comptroller in our office engages public companies directly to protect and create long-term shareholder value. The New York City pension funds are among the most active proponents of share owner proposals. We are focusing on advocating for regulatory reforms and promoting responsible business practices in the companies that we invest. So, that is what we do, and that is the state of BAM today. Let me just move to some remarks on some exciting new priorities and initiatives that BAM is working on, and that we hope that many of you will play a big role in helping us to execute. First of all, our diversity initiatives, some of which you've heard already this morning. BAM, together with our systems consultants, we are working with our trustees on new initiatives to drive engagement and utilization of emerging managers, including women and minority-owned firms. As you've mentioned, and you see the top of the list here, we have a new Office of Diversity and Inclusion. We're excited to have Siobhan Sutton join the team earlier this summer. She reports directly to me, and she is charged with assisting emerging managers navigate BAM, which sometimes is complicated. We've heard that feedback. and understand and help you understand our investment processes. But she's also working internally, working with everyone on the BAM team to develop and construct new strategies to expand opportunities and allocations to diverse managers. Now, the next initiative, certainly one, I'm excited about all of them, but the next one is really exciting. You know, we are currently working, as Comptroller Stringer mentioned, on analyzing the market opportunity for us to expand our investments with first-time funds and early-stage investment managers in alternatives. Specifically, we're looking for the new and next and brightest minds and firms in private equity, in real estate, in infrastructure, in hedge funds, and alternative credit. Now, we're looking to source one or more firms to help New York City lead this initiative. We want to partner with an asset manager that will help us identify, source, and make investments on behalf of the New York City systems in first-time fund managers. I know this week I saw several of you in our offices today engaging our teams on this opportunity. Please look for further detail on this very exciting new initiative in the breakout sessions later this morning. Now, we're also working with our boards to expand our very successful in-house private equity emerging manager program. This would be the second time that we re-up this program. And for those that know me, I began my tenure at New York City in March of 2012, leading the emerging manager program in private equity. And I'm proud as to how we've grown that portfolio with incredible managers that are delivering for our beneficiaries every single day. That program began with an allocation of $425 million. When the Comptroller Stringer, came into office, he immediately helped us work with the trustees, and we allocated an additional $500 million to that program. I'm happy to announce that we are close, and we expect that by the end of the year, that $500 million allocation will be fully committed. And because of that, the private equity team is now beginning to do their work to work with our trustees to pursue another allocation to this program of hopefully at least $500 million in early 2019. And of course, we will continue to build on the success of our existing emerging manager initiatives. We have our fund-to-funds program in public equities. We are expanding our manager search criteria so that we include more emerging managers and diverse managers. That's very important. We don't want our criteria to be a barrier to maximizing the number of participants that compete for the dollars that we have to allocate. And as was also mentioned, we're looking to actively transition those successful managers into direct allocations. Also want to review just several corporate governance initiatives where the Comptroller and the corporate governance team has been incredibly successful. In proxy voting alone, in fiscal year 2018, New York City voted on over 45,000 ballot items, and that's at over 4,000 annual and special meetings globally. This office has delivered great wins for the Comptroller, and it has been led through his leadership with the groundbreaking Boardroom Accountability Project, which was launched in the fall of 2014, to make U.S. boards more accountable, more independent, diverse, and climate competent. Since the launch of the 2.0 or 2.0 campaign last September, 49 targeted companies have elected 59 new directors who identify as women or persons of color, including 44 women, 15 African Americans, 4 Hispanic Americans, and 2 Asian Americans. Please, we are very proud of that. In addition, 24 companies have publicly committed to include women and people of color in the candidate pool for every single board search going forward. Now that's exciting. We at the Comptroller's Office are very proud of this achievement. We thank Mike Garland, who leads the corporate governance group, and his team for their tireless efforts. Climate change. The Comptroller, together with the Mayor and the pension fund trustees, have been a leader on climate action. As many of you saw last month, they announced a new goal to double the investments of the New York City pension funds in climate change solutions to $4 billion, or 2% of the city's pension portfolio over the next 3 years. Now, in meeting this very ambitious goal, and consistent with our fiduciary responsibilities, BAM will work diligently with our consultants in sourcing prudent investments that meet our risk-adjusted rate of returns and recommend those to our boards for approval. Additionally, we're actively looking to integrate climate change investment risk and ESG considerations into our underwriting processes. Now, we are also working towards issuing an RFP later this year to source a consultant to assist the systems with devising a strategy to potentially divest from fossil fuel reserve owners within the next 5 years. This is important to all of us. This is important to the Comptroller, and the Comptroller is taking leadership in climate initiatives. So, let me just wrap it up with a few remarks. As you heard me state, there are many things that we are working on, and we cannot accomplish any of them on our own. This is truly a collaborative effort of the Comptroller, BAM staff, working with our trustees with all of your help, our existing and prospective investment managers. We need you. I would like to end my remarks here by extending special thanks for all that you do to, first of all, Elena Gilligo, our first Deputy Comptroller, Susanna Vickers, our Executive Director of Pensions and Designated Trustee, Mike Haddad, my partner, Deputy CIO for Public Markets and Tradable Securities, Wendy Garcia, our Chief Diversity Officer, all of the staff at the Bureau of Asset Management, and another special thanks with a triple underscore to the team that put this conference together. You were amazing. I am proud of the event that you guys make come to life today. Thank you. And last but certainly not least, I want to thank all of our existing managers for your partnership. We also look forward to welcoming new partners to help us continue to support and grow the retirement benefits of the 730,000 beneficiaries of this great city. Thank you so much. So with that, I will turn it to Siobhan Sutton, our Director of Diversity and Inclusion, to provide some remarks and lead us into the next portion of our conference.
Thank you, Alex. Thank you so much. I'd like to thank our Comptroller, Scott Stringer, the trustees of the 5 New York retirement systems, BAM staff, organizers, and you all for being here today. You know the statistics. Diverse firms and teams perform better than their less diverse counterparts. you've experienced for yourselves just how small and women-owned or minority-owned firms are still underrepresented across private and public markets, yet your difference and uniqueness positions you to outperform. And you're well-versed on the research that shows that strong investment performance and the use of emerging and diverse managers does not have to be mutually exclusive. We are keenly aware of this too, and it's what drives our commitment to ensuring greater access to opportunities for talented investment managers across the spectrums of size, genders, and hues. That's why we're here today. Good morning, everyone. My name is Siobhan Sutton, the first ever to hold the role of Director of Diversity and Inclusion in BAM. Thank you. And I am an investor and a proud African American woman. As a direct report to the CIO, I serve as a liaison to investment firms interested in doing business across the New York City retirement pension systems. I partner with asset class teams to source highly qualified, emerging, including MWBE asset managers for the system's portfolios. And I am charged with introducing new processes designed to increase transparency and accountability in the system's utilization of such firms and to monitor our progress against the system's diversity and inclusion goals. I bring to this role deep and diverse finance experience from large financial institutions, but it was my most recent role as a managing director at Momentum Advisors, a New York-based African-American asset management firm that exposed me to the grit, tenacity, and resourcefulness required to succeed as an emerging and MWBE firm. This 360-degree view not only makes me highly qualified to do my current work, but it makes me one of you. I stand before you not just as an investor and a woman, but as an ethnic minority, as someone who grew up in Newark, New Jersey, a risk taker like you, who took a once-in-a-lifetime opportunity to join Comptroller Stringer in pushing to bring increased equity and equality to an industry that has all at once mesmerized, intrigued, toughened, and frustrated me throughout my career. To simply say that the industry has a diversity problem is an understatement. I took this role because I am solution-oriented, and I'm here to support Comptroller Stringer's efforts to continue to be a leader in developing solutions to solve this problem. I will do my part by partnering with the BAM staff to develop asset-specific action plans around asset manager utilization, enhancing our open-door policy and procedures, and systematizing our communication and relationship management efforts with all managers seeking to do business with the retirement systems. Today, BAM's investment staff and our partners will discuss the state of the emerging manager universe and best practices in successfully building an asset management firm. And our breakout sessions will provide a breadth of information about how we invest, what we look for in our managers and MWBE broker partners, as well as how to build a relationship with us. Now you know why we're here, but I ask you, why are you here? What I hope for this conference is that each of you walks away with a clear idea of who we are, how we function and invest, and most important to you, how you can position yourselves for allocation opportunities. I challenge all managers in the room, whether emerging and/or diverse or at a large institution, to listen, question, learn, to look inward. Ask yourself, what can you do to be a better manager? And how can you better champion the mission of increased diversity and inclusion where you are? And commit. Commit to not only producing strong returns for investors, but also to our shared goal of increasing the use of best-in-class, diverse, and emerging managers in that effort. Finally, I hope that you will all continue to share your stories, provide ideas, and challenge us to walk our talk. I am a resource to you, and I encourage you to reach out. My contact information is in your booklet. Now, we will kick off today with our first panel, The State of the Emerging Manager Universe, moderated by our interim CIO, Alex Dunier. On behalf of Comptroller Stringer and the entire BAM staff, I welcome you. Thank you so much.
Thank you, Siobhan. And we'll have all the panelists come up for the first fireside chat.
Stop putting Kelly and me together. Sit next to you, man.
So let's jump right in. Well, good morning again. Please stay. This will be a fantastic panel, I promise. There's nothing out there. It's all here. Now, this morning on our first panel, I would like to engage our distinguished guest in a discussion on strategies and initiatives to move our collective agenda forward of increasing diverse manager engagement and utilization in the investment management industry. Now, we are honored today to have the foremost thought leaders in this country guide us through this discussion. We are in very interesting times, as we know, in our country, and I believe that we are challenged more than ever. So with that as a backdrop, I really just like to begin by first having each panelist very briefly introduce themselves and state the mission of their organization. Danielle.
Good morning, Danielle Beyer. I am the CEO of the New America Alliance, an organization founded in 1999 with the mission of wealth creation for the Latino community.
Good morning. Orem Graves, the Executive Director of the National Association of Securities Professionals, founded in 1985, and our mission is to promote the usage of diverse managers, diverse professionals, and women in the financial services industry, amongst other things. Thanks.
Good morning. My name is Joseph Haslip, and I'm honored to serve as the chairman of the National Association of Investment Companies. Shout out to members and members of our board that are in the audience. Our goal is simple: access to capital and to make Wall Street look like Main Street. We focus mainly in private equity and hedge funds, and we are honored to be in this place.
Grace Reyes, the president of the Asian American Association of Investment Managers. Thank you for the opportunity to be here. We were founded back in 2006 with a strong support from CalPERS, CalSTRS. Our mission is to promote gender and ethnic diversity in the industry, and we're happy to be here.
Good morning, everyone. My name is Blair C. Smith, and I am the founder and CEO of Promethean AB Strategies. I am also the senior advisor to the Culture Shifting Weekend, which is the largest gathering of African American venture capitalists on the East Coast. My mission through Promethean AB is to create opportunity for diverse investment managers as well as limited partnerships, and to bring them together to create greater opportunity.
And good morning, everyone. I'm Kelly Williams. Many of you know me as the founder of the Customized Fund Investment Group, which is now part of GCM Grosvenor, and where I am a senior advisor. But I'm here today with another hat that I wear, which is as the founding chair and co-CEO of the Private Equity Women Investor Network, PEWIN. We were founded 10 years ago. We celebrated our 10th anniversary this year. And PEWIN is focused on providing a network for the senior-most women in private equity to provide opportunities for those women to do business together and to increase the profile of women generally in the industry.
Thank you. Thank you, Kelly. Thank you all. Well, let me just jump in and simply begin by asking the question that is the title of our chat this morning. What is the current state of the diverse manager universe? And Joe, since I haven't seen you the longest.
How are you?
It's really incredible to see you. I'm excited to have you here today, as I am having everyone here today. But let me start with you, Joe, and get your point of view, the point of view of the NAIC, as what is the current state of the emerging manager universe?
I first have to apologize because those of you who know me know I'm very shy. So it's very hard for me to participate in events like this. So Alex, please bear with me. So on behalf of the NAIC family, I think it's a mixed bag. I think we're in a situation now, and having had the honor to have a summer internship that turned into a job at the Controller's Office many years ago, I have a perspective that I think that in some respects, we are going, in some particular plans, we're going forward, but in a lot of perspectives and a lot of plans, we're going backwards. We are still at a point now where we're struggling to get people to understand the value-added proposition of diversity. NAIC is proud to say that we just concluded a study about a year ago, partnered with Aon Hewitt, that shows that we outperformed, private equity diverse managers outperformed the Cambridge Private Equity Index by 500 basis points. And in places like Wisconsin and other places who I don't want to name, we still have a problem getting an audience. Now, the good news is, with blessed people like Alex Donier, Scott Stringer, New York City, New York State, and other plans, we're seeing best practices being brought to the forefront to make the case even clearer for why you should be embracing diversity. But I have to say, it is a mixed bag.
Thank you, Joe. And Grace, let me turn it to you for the same question. From your point of view and the point of view of AIM, what is the current state of the emerging manager universe?
So there's currently more awareness about the Emerging Manager Program due to the strong performance and strong returns within portfolios. We find that social media has helped a lot in our efforts in promoting diversity and inclusion and questioning the investment management industry. Also, even with these programs and initiatives, it's still challenging for smaller firms to fundraise, and it's because of regulatory requirements. Also, there's rising costs and as well as fee compression. So there was an article written by P&I just recently on October 1st about how, hedge fund starts might be record lows this year in comparison to 2000, which was about 328 hedge fund starts. And this is because, they're trying to keep their doors open. Before the model was 2 and 20. Now they're seeing 0 and 10%. So they're just trying to figure out how to keep the lights on.
Thanks, Grace. And given that point of view, obviously not a good one, meaning it is a bit cloudy or a lot cloudy or grim to hear Joe and Grace discuss it. I want to turn, and Blair, I'll have you take this question to help us understand the goals and objectives that your organization is setting to address these issues, to address the view of the state of the current state of emerging managers, to increase not only engagement but importantly utilization of diverse firms.
Well, our primary goal within Promethean AB Strategies is education, and I'd like to just piggyback on something that Joe Haslip said. There is a perception among investment managers of a big contraction over the last couple of years in allocations to diverse and women-owned firms versus an expansion. There are various reasons for that. Joe and folks like Bob Green, they keep the statistics on it, but there's just a general sentiment that there are fewer and fewer allocations being made to first-time, second-time, diverse-owned firms. Those firms that had been in the pipeline for a significant amount of time, those seem to be the ones that are making it through, and those allocations are well-deserved. But there's a whole backlog of managers out there who have great track records, strong teams that seem to have trouble even communicating with the LPs out there and trying to get themselves heard.
Thanks, Blair. And Orem, I want to hear that same question from the perspective of NASP. What are the goals and objectives of NASP? What is NASP focused on today?
Thanks, Alex. And thank you for not letting me have to follow my fellow here to the right, because he's a tough act to come. I mean, to my left, sorry.
Politically, too.
So what we're seeing, again, is kind of what Joe highlighted, a mixed bag of activity. There's a lot of activity in the consultant space around diversity and inclusion and trying to get source diverse talent through the manager community. But what I've been told by a very qualified first-time funder, a first-time fund, is that a lot of the gatekeepers who are in those D&I spaces are not really effective in promoting the interest of the diverse talent. So there's a kind of a bit of a schism there with the consultants who purport to want to do this and the actual getting the deals done, or at least the looks for these managers. There are a number of objectives that we've got to kind of try to counter that, and some of the goals we're looking at. We're going to be holding a consultant retreat in a couple of weeks where we're bringing together consultants and diverse managers to try to bridge that gap of not playing golf at the same country club. So hopefully we can come out of that with some measurable focus on increasing opportunities for managers by the time we do the program next year. We're also looking at, there's been a lot of firm attrition in the diverse, in the long-only space. And we're trying to figure out, the market hasn't been kind. You guys see it all the time. Fees are down, assets may be up, the regulatory burden's up. Baby boomers and millennials, Generation X's, baby boomers are the savers. The millennials and Gen X's are not saving. So that's also putting pressure on assets for those of you in the private client space. So our goals are trying to, again, continue to push to increase the opportunity, and also to increase those artificial limits that are placed at some funds. Some people get to 2% and they think that's a joy. And kudos to you and Controller Stringer for getting the numbers up to 10%, and you're not stopping there. But across a number of other plans, you get to 2%, and it's like, okay, we're good, and don't talk to us. Go somewhere else and tell them to get up to 2%. So that's kind of where we are.
Thanks, Orem. And I'm going to turn it to Ms. Kelly Williams. You're going to get the next question. Before I go there, I was told that please speak into the mic. They're having trouble picking up your voices. So if you can speak directly into the mic, we would appreciate it. But Kelly, you and I had a recent conversation that I thought we would share with the audience, because it was certainly enlightening for me. And one of the things that we were discussing is, in trying to help me understand the current goals and objectives of PE Win, we discussed whether those goals and objectives need to be updated, evolved. Do they need to change for the time? Do they need to be redefined for today's times? How do you answer that?
Sure. So the way I look at it, and I actually think, Alex, your opening remarks about the way BAM's program has evolved over time is very illustrative of both the state of the market and then, what each of our organizations are probably grappling with. There was a time for many of us who've been practitioners in the emerging manager or diverse manager space when just investing with a diverse manager was viewed as a risky exercise. We now are in a situation where we have breakout managers who have proven themselves to be able to perform and to really deliver outsized returns. And so you now have this dichotomy between diverse managers and emerging managers. So those managers who are more established and who have more established track records are attracting capital. So that kind of inherent risk that many of us saw decades ago, that investing with someone who was diverse was risky, has gone away. Now the issue is that now that those allocations have happened and people are sort of doubling and tripling down, the emerging managers, the smaller managers, the newer managers, the next generation managers are struggling, as you've heard the other panelists say. At PE Win, our observation is that if you look at capital creation among all different types of diverse managers, women have really not been garnering that kind of capital support in the same way that other members of the diverse manager community have, and that's for a variety of reasons. But I think that what investors, what allocators have to do is exactly what you illuminated in your discussion, in your slide, and what the comptroller talked about, which is recognizing that while it's important to make sure that you are supporting those managers who've done what they said they were going to do for you and provided returns, simply having 10 or 15 or 20% of your overall portfolio allocated to managers who identify as diverse is not enough. It has to be, what Joe said. When your portfolio looks like Main Street, then we've all done our job well. In the context of PE Win, in order to address the issues around allocations of capital to women, we've realized that we actually want to support women who want to step out and start their own firms. And it's my strong belief that there are many firms doing an excellent job of inclusion and trying to make sure that environments within private equity firms are more welcoming and inclusive for women. But I really don't think things change until women step out and start their own firms. And so within PE Win, we started an initiative called Project Pinklight, a riff on green lighting a film. This is pink lighting a woman-led firm. And it is meant to provide support to women who want to step out. It's been very successful to date. We've had 6 firms go through it. The first 2 had one-and-done closings. I think they are going to be the rock stars of the future. They will be household names in the private equity industry. But what we're finding is that more and more women are interested in actually stepping out and starting their own firms, and providing this type of support has been key. And interestingly, and we've talked about, many of us on this panel have talked about this over the years, there is a role for larger firms to play, for majority, firms to play here. I'm a big believer that if a woman or a person of color is a partner in a big private equity firm and they decide to leave, we as allocators don't necessarily have to give you a demerit if you handle it the right way. If you provide support to that person, if you recognize that they've been a great contributing partner in your firm, and you say, well, not only are we excited for you to do your own thing, we want to put our own capital behind you, we're going to give you the names of our LPs and help you fundraise. If you show allocators that you are willing to support diversity, not just by having somebody working in your own firm, but actually helping them go out into the world and be the progeny of your firm, that's a great thing. And I've seen a couple of firms do that recently, and I really applaud them for handling it that way. And I think that is really a way that more of the majority-owned firms who maybe aren't being as successful holding on to women and minority professionals, that you can actually continue to contribute to our asset class in a positive way by encouraging those individuals and positioning them for success.
Thanks, Kelly. I couldn't agree more. And Danielle, really wanted to turn it to you now. In our discussions, you discuss the NAA's view of the current state of the emerging manager universe as the tale of two worlds. and would love you to help us explain that, but also importantly, address what are the new initiatives that the NAA is working on that could be of interest to many of our audience members to address these issues and concerns.
Thank you, Alex. And I want to echo some of the points that Joe mentioned earlier in terms of the mixed bag when he answered the question regarding the state of the emerging manager universe. Excuse me. I have to agree. In terms of my comment on the tale of two worlds, is that we have now reached a point where some of the first and original emerging manager programs are in need of a refresh, in the sense that perhaps when they were originally established, they had a specific dollar target, and now that dollar amount is really not meaningful anymore. And so we have those programs not in New York City that we are working with to ensure that those allocations really keep up pace with the opportunities in the market in this space. And then you have the private pools of money that are really taking this seriously and almost, in some cases, rushing and trying to find diverse managers that they can put in their portfolios to put their capital to work. What do I mean by that? You have foundations, you have endowments, you have family offices. And in fact, Alex, to answer your question about what new strategies NAA is pursuing for that, is really trying to engage with those pools of money as well. Historically, emerging managers, diverse managers have really sought public pensions out as a main source of capital, and we're really seeing that the private pools of money, one, can move fairly quickly, can be very flexible, and can also be very, very good partners for the emerging manager space. So I hope I answered the question quickly enough.
You sure did, and I'm getting the sign that we're running out of time. But two things that I did want to address, I think Kelly partially addressed one of the questions that I had, which is really trying to identify strategies that majority firms, can employ to foster diversity in their own organizations or support their own investment staff with their desires. Kelly addressed that, but I'll turn a question to you, Joe, in parting here, is what can emerging manager firms do to best position themselves for success?
Well,
what advice do you have for them?
There are a couple things you can do. First of all, it's very important that you make contact with your investors. People need to know you exist. That's critically important. You have to do that. I also think, believe it or not, that to the degree that you can get exposure on some of the social media networks that exist, as well as the TV networks like CNBC and some of the other groups, that's important. I can't tell you how many times when you walk into a CIO's office, they looking on the television, they have the market, they're tracking the market every day, they're looking at the news. That is critically important for you to think about working. The other thing I'd say, and it just it touches on a point that you raised with regard to strategic relationships and what majority firms can do, is very interesting. Jarvis Hollingsworth, who was the chairman of the Texas Teacher Pension Fund, several years ago, right before the market downturn, they invested strategically in the capital structure of 6 of the largest asset managers platforms that exist, people like Blackstone, KKR, and others. And he brought those individuals together recently and challenged them. He challenged them to go out of their way and figure out to do 2 things: increase the amount of women and minorities working in your firm, but also figure out how you can joint venture or partner with an asset management firm that can create value in the marketplace. I would encourage many of you not just to bombard Texas teachers, but be about the business of thinking a little bit more outside of the box. Kelly brought up an interesting point with regard to all the work that they're doing. That's why at NAIC we're so happy that we tricked her to come and help lead our effort around women in private equity, where we partner with the American Investment Council to try to not just increase the number of women that work on Wall Street, but increase the amount of women that are in leadership on Wall Street of asset management platforms. The other thing I would say, since time is running out and I talk too much, is I think it's also important that we start to change the game. At NAIC, one thing that we took it upon ourselves to try to do is we partnered on a new initiative called the Diverse Asset Manager Initiative. We're fortunate that we were able to get the leadership of Mary Kay Henry, who's the international president of SEIU, to work with us along with other unions like the AFT and others. We have to, as much as we love our public pension plans, as much as I loved working at a public pension plan, managers, we have to begin to turn our attention and have conversations with foundations, endowments, and corporate plans to diversify the pool where we have levels of engagement.
Well, thank you, Joe, and thank you, rest of our panelists. I encourage everyone to find our panelists throughout the day. They provided you what I think very interesting and provocative ideas as to how we continue to move forward with this agenda of increasing the allocations to diverse firms. So please seek them out. They will be here throughout the day. Thank you. And with that, please do not get up. We have our next exciting panel. We have our Deputy CIO for Public Markets and Tradable Securities, Mike Haddad, who will be leading a panel on emerging and minority and women managers' best practices in successfully establishing, building, and growing a diverse firm. I turn it over to Mike Haddad.
Martin. Good to see you. Yeah, this should be easy enough. We're walking somewhere on the plane, so it's kind of hard to dial in. Could we get Frank and Sue to come up as well? We're gonna jump right in, try and keep the agenda on time. Again, I'm Mike Haddad. I'm the Deputy CIO of Public Markets and Tradable Securities. And like my former colleagues, I welcome everyone to our annual Emerging Management MWB conference. And I have the privilege this morning of moderating the next panel. And it's a mouthful, so it's the Emerging and Minority and Women Managers on Best Practices in Successfully Establishing, Building, and Growing a Diverse Investment Firm. And in full disclosure, I was asked to moderate this panel because as the title of this panel is very long, I have the longest title in words at BAM. The objective of this panel is two parts. And broadly, one, we want to hear from the panelists on how you've built your firms. And then two, your experiences in dealing with BAM. Good, bad, and the ugly, all of it. And all of our panelists here have founded their own firms, have built their own firms, and they represent 4 different asset classes. We have private equity, we have public equity, we have real estate, and we have hedge funds. And before I ask the panelists to introduce themselves and get going, I want to thank you in 2 ways. First, for your partnership and your contributions to our 730,000 beneficiaries in meeting our investment objectives. And secondly, on behalf of Controller Stringer and all of us at BAM, agreeing to participate on this panel and share your insights with the group. So I thank you for those 2 things. So let's, starting with you, Frank, a brief introduction about who you are in your firm, and then we'll jump into the questions.
Okay, I'll keep it brief. Frank Baker. I started and managed a firm called Sears Capital. We're a private equity strategy. We only do control investments, and we focus on mature or value investments in technology. We manage about $6 billion currently.
Good morning. My name is Martin Chavez. I'm a co-founder and managing partner of NMS Capital. We are a lower middle market private equity firm exclusively focused on healthcare services and business services. launched in the end of 2010, and we currently manage $750 million.
Thank you.
I share.
Good morning, everyone. I'm Tammy Jones, and I am the CEO and founder of Basis Investment Group. And Basis is a diversified investment manager that focuses on debt and preferred equity strategies that are all collateralized by commercial real estate that is primarily located in the middle market. We have closed over $3 billion in transactions, deploying over $1 billion in equity across 297 deals in 47 states.
Hi, good morning. My name is Sue Kim. I'm a hedge fund manager of a firm called Standard General. We are an event-driven opportunity manager, and we manage a little over $1 billion.
Good morning. My name is Michelle Allen. I'm the President and Chief Investment Officer of Metis Global Partners. Metis is a global equity manager in San Diego, California. We manage a range of global, international, and emerging market active strategies. And we were founded at the end of 2013, about 4.5 years ago. We currently manage about $650 million.
Thanks. So each of your firms shares two commonalities. You manage money on behalf of New York City Retirement Systems, and each of you have diverse firms. Other than that, you guys don't have much in common. So with that in mind, and I'm going to give you any latitude you want to take this question, share with the audience how you founded your firm, the vision, how you've built your firm, how you've grown your firm, hired staff, invested money, while maintaining your commitment and vision of remaining a diverse firm. And we'll just start in the other order. So Michelle, if I could ask you to begin, let's just work our way down the panel.
Okay. Well, I think our firm is a good example of something Kelly Williams mentioned in the last session, in that we spun out of a very large majority-owned firm. It was a friendly spin-out. The background on that is that I managed the quantitative research team at Brandis Investment Partners, which is a large global equity manager in San Diego, for about a decade. And during that time, we built the investment process that we use today at Metis, but we originally built it for Brandis. They went through some business changes, and we all realized that there was an opportunity to unlock the value of what we had built. And they were receptive to that. We made them a proposal. The proposal included us partnering with them in the sense that they would provide all of our operational outsource, so back office, trading, and some distribution partnerships as well. And I think they saw the merit in that, and there was a lot of trust between us. So it was a very open dialogue, a very candid process. And at the end of the day, the entire quantitative team lifted out, and we launched Metis. One of the things we did have to do, though, as part of the agreement, is we had to go find our own working capital. So they didn't just write us a check and hand us that. They said, the infrastructure is here. If you can get the money to fund your firm, then let's do this. And so we did. And that process is, I think it can't be understated or overstated how difficult that part of the formula is. It's hard to go out there and find somebody who will hand you several $1 million to get a firm across the break-even line. And we had to look everywhere, high, low, under rocks, upside down, and backwards. At the end of the day, we were able to find someone who understood the industry very well, and I think often that's key. In this case, it was a gentleman who was the founder of Invesco, and so he had founded several large management firms and saw the potential. So that really speaks to how we launched. I think you asked some other questions about how we have grown our firm and focused. I think what has been our North Star was a lot of pre-planning and thought. We spent almost a year developing out, researching, and building our business plan, and we executed on it step by step by step. We had to modify along the way in places, but having that very clear path that was very well thought out, I think at the end of the day has got us to where we are today. I'll stop there because I know we've got 4 other people, but that's just one element.
Great. Well, congratulations.
Well, thanks.
And so I worked for other people for almost 9 years. And at the end, we had helped build businesses together. And at the end, I was also a partner of that business and also the director of research. So
being in sort of the catbird seat when you build a business, it gives you a lot of confidence in terms of knowing that when it's time to start your own, when you think that you're ready, that you can do it, and it's not magic. So I try to recommend to people that they spend time working for others. I mean, frankly, that time in the beginning part of your career, you're really getting paid to learn. And even though you may be in a rush to do your own thing, spend that time to learn from others, because that's really how everything is sort of passed down. So again, after almost 9 years of working for other people, two things happened. One is that I built my own confidence that I was ready to go. Let me say three things happened. First, the confidence building that you can actually do it, and you put yourself in the position of responsibility so that when you had to make the call, that you can make it. The second thing is that you've actually built up enough of a professional reputation where people knew who I was, which is surprising, because I work in a very esoteric field. But when people start to say, hey, what's your future plans? And if you ever want to do your own thing, maybe we should talk. And so when that starts to build up, you'll feel that. And whenever people ask me, well, how did you know when you wanted to start your business? And it's because you sort of had the sense that there was demand for it. And then finally, business building is deeply entrepreneurial, and it's in some ways it's very lonely. So you need to have good partners to do it with. You have to wake up every morning and start over again. And these kind of things, you just need to be ready for. You need to be in the right place. And so, I always try to advise people to know themselves, know when they're ready. In my case, the third thing is that, I had actually, I think, made, some money working for other people so that I felt confident that, I can put this money into my new business, and if I lost it, that was okay. I think that sort of entrepreneurial, self-starter, risk-taking behavior is definitely something that you need to have. And so just make sure that you have that deep inside before you start.
Sue, before we jump to Tammy, your firm is a past winner of the Comptroller's Diverse Practitioner Award. So maybe a quick comment on how you have grown to remain that diversity and conscious,
Sure.
unconscious.
Sure. I mean, what's called, the award came as a surprise, but thank you. Look, I think our first job is ultimately to protect money and make it grow. So if you don't do that well, then just never forget the first job. But look, I also believe that I never forget where I'm from. And so, I was born in Korea, but I moved to New York City when I was 5. I grew up in New York City. I'm a very proud citizen of this place. I've never left, and you can't get me to leave. So. So it's a real deep honor to work for the city, and so what I would say is that when I build my business, I think about where I'm from. I don't forget my mission, but I also don't forget where I'm from, and so I can say, out of my 7 sort of investment, we have 18 people total. Out of the 7, sort of frontline investment professionals, 5 are women and minorities, And I think that's because that's who I am and that's where I'm from, and I haven't forgot that, even though my overall mission is to make sure that we protect money and make it grow. But also, I also find myself in a position where my investment strategy is actually a very active investment strategy. We own bonds, bank loans, and equities, and we believe that not only do we have those economic rights, but we also have the ability to dialogue with boards and management teams and help effectuate the change that we think will help us make more money. And we've actually find ourselves in a position where we've been able to have some say as to who the officers of a company are, who the directors of a company are. And, I can say that, one day we actually counted just because somebody asked me the question, and I think there was probably many, but I don't even know. We've actually appointed almost 10 or more than 10 women and minorities into positions of either officers or directors of public companies. And so I don't know, it's funny, I didn't do that because, look, ultimately the mission of a company is to make more money, and to sustain itself. So you have to make sure that that's done. But I think it's really important never to forget where you're from and make sure that you're lifting up, communities, because people help lift you up. So,
thanks. Tammy?
So thank you. I think we have a lot in common in terms of how we think. So I'll tell a little bit about how I launched Basis. So I really started my career in the institutional world, and I worked for Equitable, for GM, and for the Case Depot, and really managing capital on behalf of pension funds in all real estate debt and equity strategies. So like you, I kind of learned and had, learned from working at larger institutions that I could bring to bear when I actually wanted to form my own platform. So you have to have that entrepreneurial spirit. So I agree with Sue on that. So I think that was always in me. I don't think that happened, I think from being a very young girl, I was always, enterprising and doing different things. And so I decided to form Basis, kind of to the point of knowing when you're ready, sometimes it happens when you don't really know you're ready, and the great financial crisis hit. So I founded Basis in 2009. And at that particular time, you guys remember, it's amazing how, that seems so long ago, but it really wasn't that long ago. The market kind of shut down. And I have a type A personality, and I was working for the Case Depot's subsidiary, CW Capital, and I had actually had the great opportunity to run and launch their debt platform, where I had 80 people working for me in 5 offices and literally built that from scratch. What great training to go out on your own, right? And I decided to write a business plan. And since I ran the platform, I had access to a lot of large family office capital, and I literally made a list of my top 10 clients/partners who I had invested with. And I got down to number 7 and was able to get my first $100 million. And what I decided was 100% of zero was zero. So I found a GP sponsor who provided me with working capital, with infrastructure, with actually an office, because, all those things you have to think about. And then he also gave this family office gave the firm our first $100 million. And from there, it was all about building the track record and trying to raise capital by strategy. And so that's what I did year after year. And, I decided that going into the fundraising world wasn't for me because I wasn't confident that we would be successful. So I decided to go about it a different way, which shows you that I'm sure there are different paths, that there's other ways to go about this. And so that was phase 1. So we built our track record, kept in touch with a number of different investors, and then phase 2 of Basis, in order to scale, was to actually raise a commingled fund after we had closed, almost $3 billion. And we decided to go and embark on our first raise a little less than a year ago. And we decided to try to partner with an institution that's in this room. I don't know if I should say their name, but they gave us our seed capital, Peter Brafman. And we got our first $55 million. And one of the things that you should think about is how to differentiate yourself if you do embark upon going into the fundraising world. And so we decided to, put together a seed portfolio. So we had an anchor investor. We put together a seed portfolio to demonstrate that we could achieve those returns in today's market. And then the third thing we did was contribute it to the fund. And actually, New York City, thankfully, was our second investor. And I think, the rest is history. That strategy worked. And again, trying to figure out how to differentiate yourself from blind pools that are competing in your strategy. Because now we have 13 other public plans, and we're just about to end our raise. So.
Thank you. Thanks. All right, I'm going to try to keep it somewhat short here, in light of all the great stories. But Martin Chavez shared with you how I co-founded the firm in 2010. I guess I sometimes ask myself if I'm very stubborn or just not very good, because I've been trying to raise a private equity firm since 1997. When I first got out of business school and attempted to raise my own sort of pledge fund, or I guess first-time private equity fund, and obviously the answer was no, with no track record actually, and no prior investment experience. So fast forward to, after spending 13 years at Goldman Sachs, had the opportunity, very similar after the financial crisis, to acquire our portfolio companies that we have built inside Goldman and spun out backed by institutional investor. So that was a very smooth transition, very supportive of that group, and very much appreciated for the opportunity that they gave myself and my partners as we launched the firm. Beyond that, as everyone has said, it was very much focused on building a strong track record, sticking to your strategy, and we've been very fortunate to have received a lot of support. New York City was one of our first investors in our second fund and continue to be a partner of ours in the third fund and the latest vehicle that we've raised. One of the angles of the question, so I'm going to pivot away from that, was how do you sort of embed or build on diversity across the building of your firm? And I think, look, one of the benefits that we had as NMS was when we spun out with portfolio companies and really 2 individuals. So we were able to start from a sort of clean slate or blank sheet of paper as we thought about building our own firm. And the perspective that we took, or the commitment that we made, was that at every function of the organization, we were going to think about how to make it a more diverse environment from the perspective of investment processes, investment decisions, senior professionals, people that we back, operating partners that we partner with, the advisors and service providers that we used and leveraged. And so with that sort of perspective from the beginning and from the top all the way down to the functional levels of the organization, I think we've been able to create a fairly diverse firm that I'm proud of to obviously lead. Our portfolio companies is run by a very diverse group of individuals, women, minority, across the 6, 7 portfolio companies in each of the respective funds. And our strategic advisory committee is also comprised of very diverse individuals, not only from an ethnicity and background perspective, but also from all backgrounds of education as well as industry perspective, ranging from an individual that spent his entire life a Korn Ferry building diverse teams to a former SEC commissioner that's very focused on Hispanic initiatives.
Nothing like going last. So maybe I'll be just a little bit more tactical because all of our stories have a common thread to it. I think when I think about building Cirrus and our ability really to get that first fund closed that allowed us to build our team, there are kind of 3 things that jump out in my mind that I remember about that journey. First, we had a very specific investment strategy. And, alternatives is crowded. There are a lot of GPs out there and a lot of people trying to raise money, and you need to be able to articulate a very crisp strategy on how you're going to create alpha. And my partners and I started a private equity fund called Ripplewood Holdings. We were the technology team there, and we had a very specific view on how we wanted to invest in value tech opportunities. And it made a lot of sense, but as we were leaving Ripplewood, we weren't quite ready to raise an institutional fund, largely because of track record issues. We had a track record at Ripplewood, but it was complicated because we were carving it out of a larger firm. So an important first decision that we made, instead of going out to try to raise institutional money, we went to a hedge fund. And that hedge fund backed us to do our first few private equity deals, and they were successful. So now after leaving Ripplewood and spending a few years at a private equity firm, then we actually had our own independent track record executing on the strategy that we had followed at Ripplewood. And that was pretty critical, and that really set the stage for us to go out and raise our first fund. We launched at the beginning of 2011. It was incredibly long and incredibly painful. It took us about 2 years. But we got to a first close 9 months in, and we closed on $120 million. And while we were fundraising, we were also looking for our first investment, which was important too, because that was the third and probably most important point. That $120 million first close was all emerging manager money. New York City was part of it, as was Muller Monroe, Credit Suisse Customized Fund Group. Kelly's in the room someplace. She was a big part of that as well. And so that put us on the field. But that first deal, which also had a bunch of LP co-invest, is really what accelerated the fund, because there were a bunch of non-emerging manager LPs that were evaluating us, but didn't really know what to make of us yet. And they got in the weeds with us and watched this due diligence and execute that first deal, and they all kind of looked at themselves and said, these guys may actually know what they're doing. And then they came into the fund, and that really accelerated us to where we got to for that very first institutional fund. Let me also hit on the diversity question, because I think we do have a responsibility to have diverse firms. And it's like anything else. You have to measure it, you have to have KPIs around it, and you have to hold your people accountable. Including myself, at Cirrus, we have 6 partners. 2 of us are African American, 1 is Mexican American. That's not by accident. We made it a priority. Our core investment team is about 20 professionals. Of those 20, 5 of them are women. 2 of them are African American women. And again, that's because we made it a priority. And when we recruit and when we're on campus looking for new investment professionals, it's critical that we're looking for the types of people that will keep our organization diverse.
Michael, since I didn't answer the diversity question, I feel a little lonely, so I'm going to have to jump in. So I couldn't agree more with all of what you guys said about being intentional about it, and I just wanted to add that Basis is 77% women and minorities. We have 50% of our vendors are women and minorities, and we also have invested and loaned $600 million with other qualified minority and women-owned real estate companies. So I'm really proud of that. The other thing that I would say that we do that some people agree with and some people don't, it works for us, is we employ the Rooney Rule. Everyone knows that at least a woman or minority has to be in the roster of the candidates that we interview. That does not mean that they get the job, but it just means that we are making sure that our headhunters understand, that we are forcing whoever does business with us to understand how important diversity is. So I just wanted to add that.
Great. So broad question too. You all have money from New York City. There are many in the audience who would love to do business with New York City. So can you share your experience, either share or maybe lessons learned on how your relationship with New York City has it started, how it's grown, any lessons learned you want to share with the audience? And this one I'm going to ask for order, and the firms who have had the shortest to the lengthiest. So Frank, I'm sorry, you're last again, because they're the senior one at the table. Relationship with New York City. And if I did my homework right, I think the order is Tammy, Michelle, Martine, Sue, and Frank.
Okay, so I think we're getting the sign that we should wrap it up soon, but I'm going to be really quick. So I am very grateful that New York City came in as our second investor, because the process is, very, very extensive. You need to, make sure that you are prepared to go through this process. And I'll tell you quickly, I'd been talking to New York City through Janet and Yvonne in the real estate group for like 4 years, honestly. Keeping them updated on my progress, checking in, letting them know that I was out there, that's important. And once I got into the process, I will tell you that it prepared me for the other 13 plans, because even though, I wasn't, in my view, I didn't sail through the process, because again, you have to make sure that you have all your ducks in order. I learned a lot through the process. I learned, to take criticism, constructive criticism, which you have to be, not have a thin skin in this business. And so I will tell you that if New York City, I hadn't gone through the New York City process first, I honestly don't know if I would have been as successful, because on the spectrum of extensive, they really prepared me for the other LPs. And so I'm very grateful for that.
It was me next? Yes. Okay. So as a public equity manager, I believe New York City uses manager of managers across that whole platform, and so that's how we came to have the opportunity to manage money for New York City. In this case, it was through FIS Group. We've been managing money for about 1.5 years now. The process for us, time's up, the process for us, as we're about done, was 30 seconds. All right, just
it's hard to do that.
It is hard to get it. We met through speed dating. I met Mark Gross through speed dating. That parlayed into FIS selecting us, and since then there's been really open doors from the city to come in and meet with the investment team, which we've been able to do directly and begin to build that relationship that hopefully ultimately transitions into graduation.
Martine.
Sure. I'll make it very quick. A couple of just takeaways without telling you the story. First, I think it's important, as I was thinking, preparing for this morning, that how we met the New York City staff at BAM was really through a cold call. I really want you to know that I sent an email out explaining who we were and that we were trying to raise capital, and the email was returned very promptly, and that was the beginning of a great relationship that's evolved, obviously, over several years. So I encourage everybody to follow up as needed because they are very responsive. So that's my first observation. The second observation I would say is, and I'm not just saying this because I'm here, we have 17, 18 pension plans in our latest fund, and I can say it with a straight face that the staff at BAM has been always the most responsive and the most prepared of any of the other groups that I've met with personally, and there may be some of these other groups here today, and I'm sure I'm going to hear about it, but I genuinely mean that, and I think that speaks volumes about their commitment and our very positive experience now spanning over 2 private equity funds.
Very kind words, thank you.
Okay, and just really quickly, I would just say patience and perseverance, because my first meeting with New York, I totally bombed the meeting. So it was probably one of my worst meetings of all time. I remember walking up and like, oh my God, I can't believe I ruined that opportunity. And but luckily, the staff, the people that were there, I think they were understanding and they were willing to ask follow-up questions. And we built a relationship over almost a year after that. And so persevere and be patient.
I'll go very quickly. If I could just use 2 words, I'd say world-class. You heard it this morning. There's a commitment to backing managers like us. And I've seen every piece of the cycle. I was an emerging manager. And I met Alex and team at a conference like this. And I made it through that process. I was backed. Once I was in that program, I got further support from New York City because they wanted me to go from an emerging manager allocation to a core allocation, and that was their focus, and I achieved that goal. And now we've gotten our second core allocation from New York City, and the support not only started as an emerging manager, but it rolls all the way up to specific advice and things that we should say in front of the board to make sure that there's no issues at all. And so it's a very fulsome approach to getting people like us into the core of New York City's investment plan, and they've done an incredible job.
Please join me in thanking the panelists for sharing their insights.